Welcome back. Welcome back. This is the Intelligent Developers Podcast, led by Andre Bueno and Gerard Delane. We have a stellar guest today, Mr. Chad Musgrove. Chad, how you doing, brother?
Hey man, I'm doing well, Gerard. Thank you for having me, sir. Happy to be here. So I hope everyone is coming off of the heels of a great Thanksgiving holiday and looking forward to the holiday season. So it's good to connect, man, right before
Yes,
the end of
sir.
the year.
Absolutely, absolutely. It's the best time of year. Andre, how you doing, man?
I'm good. I've been looking forward to this conversation. We've known Chad for it's going on, I think 7 years, 6 years, something of the sort. Um,
Yeah, yeah.
been able to watch his stellar growth all over the Southeast, and I'm super excited to hop into this conversation.
Fantastic. Yes. If you're anywhere near the commercial real estate finance industry, you know this gentleman Chad. He's a mover and shaker. So we're excited about having him on today's conversation. So Chad, I think you may be the second guest we have on from Mississippi.
Uh-oh. Hey man, that's good stuff. That sounds like
So
you guys got a great
so the,
pattern going on.
there we go. There we go. So tell us, my man, how did you get started in the real estate business?
Man, wow. That takes me back right there. So I cut my chops in New York. So, went to school undergrad in New York. Um, to date myself was class of 2008. So arguably probably the worst time in history to be trying to go into financial services. Fortunately and unfortunately, I had some other things going on where Hurricane Katrina took some time out of school but came back. So around about 2011, I was finishing up with one job. I was doing some equity research in the business financial sector and covering real estate as well. And actually had a buddy reach out to me and say, "Hey, I know you've been interested in getting into real estate finance. Well, I have a friend who is a senior personnel person in HR at a real estate lending and investment shop." And I said, "Man, please tell me more." So history was written from there. That was a firm by the name of Centerline Capital Group. And so that started my tenure in the agency multifamily space. Can remember it to this day, November 7th, 2011. And as you said, history's been written since then.
Amazing. You can tell the humble, successful people. He's like, I just went to this college in New York, this little place. Which college did you go to, sir?
I went to Columbia University in New York.
There you go. I went to, maybe the best university in the world. I just went to this little place.
Hey, I think look, what I'll tell you is I think typically the school is good by what's going on in the market, right? So you had, the growth and expansion from 2000 and, call it 4 to 2008. So I think at that time everyone
Right.
wanted to be in New York and wanted to be in finance and wanted to be a banker. And then I think post the crisis,
Fair.
everyone then wanted to get on the regulator side and go into poli sci. So you might have gone to, NYU or somewhere else, but I mean, obviously,
Right.
Columbia is a great school, and I'm very thankful for my education and having had the opportunity to study there, man. I certainly believe it set me on the path I'm on today. So it's not going forgotten.
Amazing.
So in staying in that role, um, the that shop specifically that you mentioned, they've gone through many iterations, many name changes, really over the last decade or so, right?
Yeah,
Um,
yeah.
and you also had the opportunity to move around, right? You started in New York, but then you were able to come, or I guess go to Miami. Is that right?
Yeah, yeah, absolutely. Still here today. Yes, sir.
That's awesome. How did you navigate that? Like, did you know that you wanted to, I guess, make your way back to the Southeast? Um, I guess you were one of the few people who actually even left New York during that time period, as opposed to
Yeah.
everyone else who left during the pandemic, right?
That is true, man. I often tell people, I consider myself being like LeBron James. I packed up my ball and took my talents down to South Beach, leaving New York. I mean, listen, it was an incredible time, right? Especially for the agency multifamily, finance space. 2011,
Right.
12. I mean, we were incredibly busy. It was deal after deal after deal. You saw that kind of where we are today, right? That intense, kind of deleveraging period. And long story short, every deal just worked. We were incredibly busy. Cash flows were still there. Multifamily hadn't suffered as much as the single family side of the business obviously had suffered. And I think oftentimes a lot of people don't think of, Fannie outside of the, institutional commercial real estate structured finance world that we live in. I think people oftentimes don't think of, Fannie Mae and Freddie Mac and HUD as commercial multifamily. They think of the single family mortgages they know.
Right.
I will say I was very fortunate in that, when I joined, Centerline at that time, I got the opportunity to work for a great manager, a guy who I, still consider a mentor today, by the name of Stephen Cox. And it was one where we had, open and candid conversations about, the business and the future and, where we both saw ourselves, right? He had been working in the business for some time and, had the idea that he wanted to grow his team and expand it. And look, I'll say like with a little bit of everything. Like I say for myself today, I mean, the harder I work, I feel like it's just the luckier I get. And that we would have those conversations, and we were working with a gentleman who had been a broker to us, and it was during a time where Fannie Mae had actually changed their regulations. So I'm sure you guys probably either remember or read about that, Florida, and I think some people still today refer to it as kind of the boom and bust, city of Miami, right? With the condo conversions and everything that went on.
Correct.
And so, this guy probably referred us, a couple 100 million to $1 million in business. And I was a part of that team. And I mean, look, I was very green then. And, my manager was willing to lean in and help with anything I needed to do. And, I was like, hey, look, they're changing in Florida. Why don't we make this pitch to this guy? Because if we don't pick him up, I'm sure he doesn't do business with just us. Someone else is going to pick him up. And funny enough, my boss was like, "Hey, I'm 3 steps ahead of where you are, rightfully so. He's been in the business he should be." And he's like, "Yeah, I think we're gonna make him an offer." And he was like, "Hey, I threw, your hat in the ring to go down and work with him, help teach him the agency business, support him." And so I will tell you, it was a big decision at the time. Obviously New York is an incredibly dynamic place. The business was really, really moving at a rapid clip. And I think much of what we're seeing now with private credit and other things like that, and more structured finance, was really in the initial stages of the ramp up. The agencies were really kind of the main player in that 10, 11, 12 period, and even in '09, right? Because our role is to provide liquidity to the marketplace. So it was scary, but I
Right.
said, hey, if I don't do it now, when am I going to do it? And I always thought in the back of my mind that, listen, I grew up in Mississippi in a little small town on a dirt road, made my way to New York. They say if you can make it in New York, you can make it anywhere. And so it was, hey, why not take a shot and go to Miami and can carve out a little niche of my own? And look, worst case, I think like any entrepreneur would say, if the business fails, you learn your lessons. And you know what? I could go back to New York, to my alumni network, to my friend network, my social network, and I'm quite sure I'd be able to get a job. And just took the chance, Andre.
That's awesome. It sounds like,
Amazing.
you were hitting that stride early, and you were able to carve out your own space, in a really arguably a very crowded space, right? I mean, there's so many lenders who are, always competing for that Fannie Mae, Freddie Mac kind of business, and you've consistently been, globetrotting the country, meeting with different sponsors, and really building out a pipeline that way.
Yeah, yeah, absolutely, man. Absolutely. I mean, look, you fast forward to today, right? Kind of where we are. I mean, I think it's, paramount to realize that, these markets, they change, they evolve. And the one thing about the agencies, right, it's always been the tried and true business. And you mentioned one thing that always resonates is the competition, right? Because a lot of times, you have a lot of sponsors who are, doing the same business with several different lenders. And it's kind of about the ancillary products that you have and services that you provide. I think some people try to commoditize the business sometimes, but really and truly, it's like anything for real estate. It's who you trust, who's gonna lean in, who's gonna go that extra mile for you, who's gonna push, who's working to stay at the forefront of what's going on and be in communication with the agencies. And then really just kind of being that soundboard, because I think one thing for me, the philosophy has always been that, you're not just an originator or a mortgage banker or a banker or whatever somebody calls you, but you're an advisor, right? I'm here to listen and strategize and noodle and, figure out interesting ways to try to help get deals done. And listen, sometimes, we don't win them all. One thing I tell my clients all the time, I know I'm not going to do all your business, even though I want to. I know I'm not going to do all your business, but in any way I can help, I can. And I just truly believe when you pay it forward like that, it'll just come around full circle.
I read a book earlier this year called The House of Morgan. Um, it is an incredibly educational book. Have you read it yet, Chad?
I have not read it. No, you have to tell me about it for sure.
Oh, you must read it. Basically, it's the story of JP Morgan.
Okay.
Um, and the generations of the Morgans. So John Pierpont Morgan, he worked for his dad for over 30 years before he took over the bank.
That is that.
So it is a
That's a lifetime.
so it is a fascinating story on how his dad like kind of helped set him up, as well as they set up the banking industry between the US and England. As the world was going through the Industrial Revolution, they were setting up banking relationships, basically,
Wow.
and
That's
providing liquidity. Is wild. Is an incredible book, including characters like Thomas Edison. You know what I mean? Just like fascinating stories on like, obviously the Fords of the world, the Rockefellers of the world, and setting up U.S. Steel, right?
yeah.
Is wild. Is absolutely fascinating. So you
Does
should
he
definitely
give the
check it out.
blueprint? He gives the blueprint so you can go build out the lane banking.
There you go. There you go. There you go. But it's fascinating, like the approach of having banking relationships, which I think is still kind of prevalent, as you were just saying about how you were being an advisor, how you were assisting. That very much that was kind of the role is that like, all right, you are an entrepreneur, you need capital to do that thing. How can I set you up to do that? Right. And obviously you earn a fee for doing that. So I think it's actually, so the show is the intelligent developers. So like understanding the different characters that you're working with, understanding the different advisors you're working with will only empower you to do it better. So I'd say with that being said, you look at a lot of different sponsors, you look at a lot of different deals, kind of from your perspective as a lender, what are some advice would you give for like some up and coming developers, or even some senior developers that are trying to navigate, different markets?
Yeah, I mean, listen, I would say, especially right now, like I mentioned earlier, being in this deleveraging cycle, I think the important thing is that, understanding your deal is always paramount to the business, right? But understanding what is important to your deal right now and in the now. I mean, I know everyone is, hyper focused on rates. Interest rate sensitivity is a huge thing. We had a deal that locked the other day, and the sponsor called and they were like, "Hey, did you guys already lock the rate?" I'm like, man, the treasury fell another 10, 15 basis points. It's down to like 427 now. And I'm like, guys, the treasury would have moved the other way 10, 15 basis points and would have been, up to 460 or something again. You've been calling me, screaming at me, asking, did you lock already? Hurry up and lock. So I think the big thing is that when when you have that short-term memory, have it on both ends, right? Not necessarily that you didn't get the absolute best interest rate you could have gotten, but think about what's best for your deal. Execute on your deals today. I think in this environment, anyone who can deliver on a deal or a pipeline of deals today, and especially I think that a lot of people are trying to create programmatic relationships to go through the next kind of 15 to 24 months. Focus on executing on your deals. When someone knows that you can execute, they can say that about you, which means that they can go tell someone else about you. And to your point, Gerard, about this being a relationship business, the easiest thing for someone to do is say, hey, I've done business with Gerard. I've done business with Andre. I know how they think. I know how they operate. I know they're going to be predictable in the sense that they're going to, maintain their fiduciary responsibility to their investors. They're going to look to execute on that deal and get to the finish line as quick as possible. Right. So if a client is coming and saying, hey, can you introduce me to someone, or can you do this? It's easy to say, oh, yeah, we've done this. And you know what? At the same token, if you haven't, that's why we work on building relationships, right? We spend time with people. We get to understand them. So I would tell, emerging sponsors and listen, like you said, even the senior ones. I'll give you another prime example. A client here in Miami, I would say they're arguably a top 3 affordable housing developer in the state. If I would mention the name, you would know them. And the building, like a 600 unit property, downtown Miami, just south of Overtown, probably less than a mile from the new arena. This is, in the heart of downtown Miami. And it was interesting to me that, I've been prospecting them for a while. And so as we're sitting in their offices, which is literally right next to this development, you can look out the window or go to their parking deck and see it. And like I said, this is a substantial group, probably owns, 15, 20,000 units. And the sponsor said to me, he was like, man, I didn't think at my age I'd be working on, cultivating new banking relationships, because his most senior guy that he was working with at one of our competitors had just retired. And, he had no succession. He was just kind of, working with that guy. And that was his guy. He knew that when he sent the package, he was going to get the same results. But to the point that I mentioned earlier, like when I said, I know I'm not going to do all of my clients' deals. Like, it's important to have a, stable of lenders, because at the end of the day, we all can't do everything. Right. But I found that fascinating for, someone of their caliber, who could stroke a check in the, triple digits of hundreds of millions of dollars, but was like, yeah, I can't believe at this point in my career that I'm working on, cultivating new relationships for someone that could deliver on, it was $100 million construction loan, right, with a subsequent agency execution behind it. So, think about that as you're starting your career, and as if you're in the midpoint of your career or even the senior point of your career, right? People move around. We don't know where people are going to be. I mean, look, at this point in time, it could be a year from now or 5 years from now. So it's important to build those relationships and build good faith and just, be good stewards at the end of the day in the business.
So, I mean, what if you're on the other end of that spectrum, right? You're actually in the middle of that project and you end up with like a CapEx bust. Like how how do you see yourself acting as an advisor in that capacity? Have you been doing any pref equity recaps? Have you jumped into any of these deals to kind of save sponsors or act in that way?
Oh boy, you're hitting it right on the nail of the head, Andre. I mean, in this environment, listen, we injected ourselves with a very high dose of low interest rates, easy credit, capital markets over, call it, the last 8+ or so years, right? I was just speaking on this at a conference earlier this week. We injected ourselves with that low dose, and so I think for one, you have an entire investor base, who this cycle has been their foray into the real estate business. So they don't understand the peaks and the valleys and what is to forecome and what's happened in the past. And
Right.
so I would tell that person, Andre, that it's like, look, let's get let's get on the Teams call, let's get on the Zoom, whatever, it's the old school version, right? Of let's just close the doors, let's sit down and put pen to paper, and let's just hammer it out, and let's start thinking through ideas. And to that point, I'll give you a prime example. To the scenario you mentioned, I have a client with a transaction in Daytona Beach, Florida. Here I'm in Miami, and they took a senior bridge loan on it's a workforce housing property, naturally occurring, affordable housing. They took a senior loan plus a mezz that today the total leverage is probably, I'd arguably say, $3 or $4 million more than what the properties were.
Wow.
And, we started our conversation exactly what I told you. I said, hey, man, let's get on the phone. Let's just start talking about it and let's run this down. And I literally started the conversation with what was shocking to him. And candidly, I did it on purpose with, how much money do you expect to lose in this deal? That was the very first question when we got on the phone. It was like the old school cartoon where you kind of look left and look right. It was like, wait, what's going on?
Right.
And I said, look, man, it is a simple function of the math, right? A loan in today's market, 9 times out of 10, is going to be constrained by the debt service. It's a simple function of what your cash flow is, subject to that debt service, subject to your amortizing constant or interest rate, if it's interest only. And it's very simple math. Cash flow supports the loan amount. And I said, hey, while you executed on your business plan, due to the other confluence of factors, rise in material costs, rise in rates, rise in labor costs. We're in Florida, much like a lot of other states, it's Daytona, rise in insurance costs, rising taxes in general. So he's had, this intersection of everything kind of hitting at once. And I mean, listen, at the end of the day, it is a part of the business too, right? And in any game, and we can call this the real estate game, there are winners and there are losers. And we all try to be prudent in our investment, and again, good stewards and fiduciaries to their investors. But it's one of those things where he had no choice, right? He had no choice but to say, you know what, you're right. What are we going to do? And so literally we are in the middle of now, and I think he is having a committee call with the equity group that I put him in touch with today, actually. And what we're going to discuss is having them come in, essentially infuse him with about $15 million of equity. His existing loan was like $21 million, $15 million of equity, pay the loan down, and then negotiate with the senior lender to actually take a B position, like a mezz position, and give us time to figure out the deal, right? So, and you're probably going to ask me, well, why would the senior lender do that? Well, that senior lender, like many others, wants to recycle their capital. So they're looking for solutions as well. So I think that was something that was a bit non-traditional. Honestly, I just thought, when I thought of the idea, I was just like, hey, you're coming in as equity. You don't have to take a debt position, because that way they don't have to feel like you're trying to be malicious and just foreclose on them and take the property, but that you're friendly equity you're going to work with. So again, it comes back to good people doing good business.
I love it. I love it. I
What if,
love it.
what if you end up in a
So,
project like that? Sorry, go ahead, Gerard.
look, you first.
What if you end up in a project like that um where you're not able to come to terms with that pref equity player, and the lender starts to go down the path of actually looking to, enforce, whether it's the guarantees or whatever remedies that they have that they've negotiated. Like, how do you think about that?
I mean, listen, it's the state of the market. I mean, honestly, I'm not even thinking about it. I'm seeing it real time, right? We're a bank. We're talking to clients, and if there is going to be an extension option that's going to be executed, we may want to see some type of capital come to the deal, some type of pay down. And I mean, look, I think as long as there is communication about what's going on, I think that makes it a lot easier for the lender to say, hey, this guy just didn't go dark on me, right? We're going to move to, foreclose and do all of that stuff. Like, right. So I think it is communicating with your lender, letting them know what you're working on, letting them know the solutions you're trying to come up with, and listen, work hand in hand with them to try to understand what's going to appease them, but also what do you need to have an investor come in to restructure this deal and make it palatable for everyone.
Fantastic. Fantastic. So I like to ask this as the last question. If you could talk to 22-year-old, just graduated from Columbia University, Chad, what advice would you give?
Man, I think for real estate guys, it's always the same thing, right? I think I would, not I think I know, I would certainly tell 22-year-old Chad, don't be afraid. It's going to be all right. We're all on this journey. We'll get there one way or another. You're not going to come out unscathed. And frankly, you don't want to because that's where you learn. But, you know, your end goal hasn't your end goal will not change because I know where I am today. And that end goal is that, maybe you're either running some type of specialty finance company, same time you're an asset manager, you own, operate, develop real estate, but embrace and enjoy the journey along the way. And, you know, buy more real estate earlier and, you know, get into that game really. And I'll say I'm very happy with where I'm at, and I think the experience that I've gotten is invaluable. And I think I'm only able to say that to 22-year-old Chad because I've walked that path. I know a lot of people says, "Oh, I should have worked for a year or two and started my company and just grinded it out." Right? I wouldn't have known the financing structures that I know today. I came to work at a bank because not only did I think it was a great place, I love the people here, people I knew when I left my last competitor, but it was to learn how different business operated coming from a non-bank lender. So enjoy the journey along the way and learn and take it with you. And, just keep going after it. And that's it, really.
Fantastic. So we're going to end it there. Chad, thank you so much.
Guys, thank you for having me. Love what you're doing. Love listening to the podcast. Please keep doing it because, you are the light that people want to hear. They want to see, your smiling faces. So I look forward to hopefully coming back in the future and having more to talk about. And, hopefully this dynamic market will be in a different position. And look forward to reflect on this and talk about the future, man. But I wish you guys all the best and thank you for having me.
Thank you. Thank you.
Thank
Till
you.
next time.
Till next time.